Hi guys, welcome to this podcast where I'm going to be looking at the first part of mergers and acquisitions, which is calculating any goodwill on a company being purchased, or calculating the purchase price, and also where there is a mixture of cash and shares being issued as part of the purchase process, how we calculate one part or the other. Okay, first bit is very straightforward. We're looking at how to calculate a purchase price for an acquisition. So here we've got the statement of financial position on a company being acquired or bought by another company, and some information on things contained in the statement of financial position. And it's important that we use this information down here at the bottom to calculate the purchase price, because they are the agreed values being placed on the assets at the time of purchase. So the value of the goodwill in this company. So starting at the top, okay, we don't use the 500,000 for the non-current assets when calculating the purchase price. We're going to use agreed increase in value to 550,000. With the inventory, important to note, although the inventory in the statement of financial position was valued at 50,000, it's been agreed it's only worth 48,000. Cash straightforward. Be careful with cash. Sometimes in an exam question, the cash stays with the owner of the existing company. But here, the cash is part of the assets and the liabilities, so it's part of what has been purchased. Liabilities, take those off. And then in this question, we are told the agreed valuation on the goodwill. So the purchase price of the company is assets, take liabilities, add the goodwill, and it comes to $618,000. Okay, it's possible to change the question very slightly. So here we've got exactly the same numbers, but here we're told the purchase price is 618,000, and we need to calculate the value of the goodwill. Well, if net assets plus goodwill equals purchase price subtract net assets has got to equal goodwill. And therefore, we would just do 618,000, which was the agreed purchase price, subtract the net assets, 518,000. So it's been agreed that the goodwill in this business is worth $100,000. So quite straightforward stuff, and only two real scenarios that are likely. Okay, final thing that we need to be able to do. In this case, we've got a company ABC called the acquiring company, and it's going to fund the purchase of XYZ, which is a company being purchased or acquired, and it's going to use a mixture of shares and cash. This is quite a common thing for a business to do as part of an acquisition process. So you get, for every share that you own in the company being purchased, they will give you so many shares in the company that is buying the company, and you will also perhaps get a cash adjustment as well, so that the total value that you're being paid for the shares is met. So in this case, there's going to be an issue of 250,000 $1.50 shares at a premium of $50. So those shares have been agreed to be worth $2 a share. So the total value of the shares issued, we're going to use as 500,000. Okay, and then all we need to do to calculate the cash that is going to be given to the shareholders in addition to the shares, so long as we know the purchase price and subtract the value of the shares, we will get the amount of cash that ABC need to give to the shareholders of XYZ in addition to these 250,000 shares. Right, I'll have shared with you some questions to have a go at. This is quite straightforward. Hope you don't have any problems. Obviously, email me if you have any problems, and I'll see you shortly. Bye-bye.